Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 29th of February. I'm Daniel Lam, your host for the podcast. In my most recent client meetings and also media interviews, many were interested to know if Chinese equities are in for better times ahead. Many were quoting how Hang Seng Index has gained more than 10% from the trough this year, and a few of the high growth stocks have reported reasonable results. Well, there has been an intensification of stimulus efforts from the Chinese government lately. Now, as we acknowledged in a podcast last Thursday, this series of efforts to revive the ailing property market and private sector sentiment will likely be followed by further easing ahead. So it is the expectations of such that is keeping the Hang Seng Index firm over the last couple of weeks. So on that front, all eyes will be on the National People's Congress, the NPC, which is going to be from the 5th of March. It will be setting 2024 targets and policies. Now, the government will likely set an ambitious growth target of around 5% and keep the CPI inflation target at 3% to prevent deflation expectations from becoming entrenched. Now, CPI inflation has stayed negative since October last year, longer than expected, resulting in lower price levels at the start of 2024. The PBOC recently made it clear that it aims for a moderate rise in price levels. So therefore, a large-scale equipment upgrading and consumer goods trade-in program is likely to be announced during the NPC meetings. Now, the budget, which is to be approved during this meeting also, may leave room for moderate fiscal expansion. So the official budget deficit will likely be set at 3.5% of GDP, compared with the original 2023 budget deficit of 3%. So the broad deficit may exceed the implemented 2023 deficit by nearly 1% of GDP, to be financed by special central government bond proceeds and other funds carried over from last year, as well as newly issued bonds, with an increasing share of central bonds. So what do all these mean to investors? Well, we believe that 15,400 is a double bottom support level for the Hang Seng Index. But again, there needs to be real improvement in the economy in order to sustain this market rally. The real rates are relatively elevated despite the drop in nominal rate. So the broad-based deflationary pressures really needs to be addressed. Now, so far in this environment, the state-owned enterprises, such as banks, telcos, and energy, they had been doing very well. And this was on the back of the government's initiative to encourage SOE management to boost the market capitalization in such companies. And of course, these sectors also got some very good high dividend to offer as well. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.